Every time the market crashes, billions of dollars do not just vanish into thin air, they are quietly transferred. When panic spreads and ordinary portfolios bleed out, people assume the money is simply gone. But wealth cannot be destroyed that easily, it only changes hands. Someone is holding the bag and someone else is collecting the check, who is walking away with the cash while everyone else loses everything. To answer that, we have to look past the flashing red screens and step into a forensic investigation of human behavior, hidden financial architecture, and the master strategist of Omaha, Warren Buffett. Think about what actually happens during a systemic market collapse. The air thickens with terror, headlines flash warnings of total economic ruin, millions of investors gripped by an invisible primal panic hit the sell button at the exact same moment. They believe they are escaping danger, they believe they are cutting their losses, but beneath the surface of that chaotic rush, a very different story is unfolding. While the crowd is dumping their shares for pennies on the dollar, a select few are sitting in absolute silence, watching the transaction logs with a calm, predatory focus. They aren't panicking because they understand the oldest secret of capital markets. A market crash is never a loss of real value. It is simply a massive, forced auction where great assets are priced like garbage. To understand why this happens, we have to look at how the human brain is wired. Millions of years ago, survival meant running away from predators and abandoning sinking ships the moment danger appeared. When the stock market drops 30% in a single week, your brain does not process numbers. It processes mortal peril. The amygdala floods your system with cortisol and adrenaline, rational thought shuts down completely. You feel an overwhelming biological urge to stop the bleeding, no matter the cost. Wall Street knows this. In fact, modern electronic trading systems are practically engineered to exploit this exact biological weakness. They feed on your fear, accelerating the downward spiral until you can no longer bear the pain. And that is precisely when the trap snaps shut. Because when you sell at the absolute bottom, driven by pure terror, who do you think is buying your shares? Do you think it is another panicked amateur? Absolutely not. The person on the other side of that trade is calm, liquid, and prepared. They have spent years building a fortress of cash, waiting patiently for the exact moment the herd loses its mind. This brings us to a chilling realization about the financial system. Volatility is not a bug in the system. It is a feature. It is a wealth transfer mechanism designed to root money away from the impatient and hand it directly to the disciplined. When Warren Buffett looks at a crashing market, he doesn't see a tragedy. He sees a crime scene where emotional investors have murdered their own financial futures out of sheer panic. He realized early in his career that the stock market is essentially a giant psychological testing ground. Most people treat stocks like lottery tickets or digital arcade games, checking their portfolios 20 times a day as if their self-worth depended on daily price fluctuations. But Buffett treats a stock certificate for what it actually is, a fractional ownership stake in a real, breathing, cash-generating business. Imagine owning a local apartment building. If the real estate market crashes tomorrow and your neighbor panics, running into the street shouting that his property is worthless, do you immediately sell your building for a fraction of what it cost? Of course not. You know the tenants are still paying rent. You know the roof is still solid. You know the building's underlying economic engine hasn't changed at all. Yet, the moment people buy shares of a publicly traded company on a smartphone screen, that basic common sense completely vanishes. They let a manic-depressive neighbor named Mr. Market dictate the value of their property every single second of the day. This brings us to a deeper, hidden layer of how the wealthy survive and thrive when disaster strikes. It comes down to a concept most investors despise: holding dry powder. During a raging bull market, holding cash feels like a curse. Everyone around you is making quick gains, boasting about their speculative wins, and making you feel foolish for letting your money sit safely in reserves. Financial media pundits mock cash, calling it trash, urging you to stay fully invested at all times because missing a single day of the market will ruin your future. Buffett completely ignores that noise. For him, cash is not a lazy asset. Cash is oxygen. When a financial hurricane hits, credit markets freeze, banks lock their vaults, and businesses that looked invincible suddenly find themselves drowning in short-term debt. They need cash to survive the week. They need liquidity just to keep the lights on, and because they are desperate, they have to come crawling to the few people who actually have capital. This is where the real power dynamic shifts. When you are the one holding the cash while everyone else is drowning, you don't chase deals. Deals chase you. You get to dictate the terms, secure elite equity at distressed prices, and lock in returns that ordinary investors can only dream of. Consider how this played out during historical financial crises. While major institutions were begging for emergency interventions, Buffett was quietly deploying billions of dollars into iconic, rock-solid businesses on terms so favorable they sounded like fiction. He wasn't guessing where the bottom was. He didn't need a crystal ball. He simply relied on a fortress-like balance sheet and an unshakable understanding of business fundamentals. He knew that even if the world economy felt like it was ending, people would still need insurance, electricity, food, and transportation. The human economy doesn't stop just because Wall Street is having a collective nervous breakdown. This leads us to the core economic shield that protects true wealth during a crash: pricing power. Not all businesses are created equal. When inflation spikes or a recession hits, weak companies are squeezed from both sides. Their customers stop buying and their operating costs skyrocket. They bleed cash rapidly. But a truly exceptional business, the kind Buffett obsessively hunts for, possesses an economic moat so wide and deep that it can raise its prices right in the middle of a disaster without losing a single loyal customer. Why? Because their product or service is deeply integrated into daily life. It is an essential utility or a beloved habit that people cannot live without. When a company has true pricing power, its cash flows remain remarkably stable even while its stock price is getting hammered by macro-level panic. Think about the sheer psychological disconnect that creates. On one side, you have a business generating millions of steady, predictable dollars every single month. On the other side, because of herd panic and algorithmic selling, the market price of that business has been cut in half. To an emotional investor, that falling stock price looks like a warning sign. To a forensic analyst like Buffett, it looks like a flashing neon sign pointing directly to a massive discount. This is where the anatomy of compounding reveals its true, brutal nature. Most people think compounding is a smooth, gentle upward curve that rewards you equally every year. It isn't. Compounding is jagged, violent, and punctuated by terrifying drops. It tests your psychological endurance to its absolute limits. The people who capture the ultimate power of compounding are not the ones who dodge every storm. They are the ones who survive the storms with their capital intact, ready to deploy when the skies finally clear. They understand that wealth is built during the good times, but it is cemented during the bad times. When you study the behavioral patterns of elite wealth builders, you notice a striking commonality. They operate with a profound sense of independence. They do not care what the financial media is shouting. They do not care if their neighbors think they are missing out. They have cultivated an inner scorecard rather than an outer scorecard. They measure their success not by how much their portfolio grew this month, but by whether they stayed true to their rigorous principles when everyone else lost their heads. Developing that kind of emotional armor doesn't happen by accident. It requires conscious mental preparation long before a crisis ever arrives. It means stress testing your own psychology. Ask yourself honestly, how do you react when your investments drop 20%? Do your palms sweat? Do you check your account every 10 minutes hoping for a miracle? If so, your financial architecture is built on sand, not stone. You are vulnerable to the exact panic trap that transfers wealth away from the masses. To break free from that cycle, you have to completely redefine your relationship with uncertainty. Uncertainty is not a threat to be feared. It is the very engine that creates mispriced assets. If markets were completely rational and predictable all the time, bargains would never exist. Exceptional returns are only possible because other people are prone to terror, overreaction, and short-term thinking. The market is essentially a mechanism that transfers money from the impatient to the patient and from the emotional to the disciplined. As you look at the chaotic landscape of modern financial markets, realize that another storm is always coming. It might be triggered by inflation, geopolitical tension, or a sudden credit crunch. When it arrives, the headlines will scream, the crowds will panic, and the urge to sell will feel overwhelming. In that exact moment, remember the silent observer in Omaha reading a book while the world loses its mind. Remember that volatility is a test, cash is a weapon, and true wealth belongs to those who keep their composure while everyone else is handing their fortunes away. If this deep dive into the psychology of market crashes opened your eyes to how wealth is really preserved and protected, hit that subscribe button right now, drop a comment below with your biggest realization, and share this video with someone who needs to see the market through a completely different lens.